2U, the education tech company that bet everything on one model. In 2024, 2U announced it would sell edX, its crown jewel acquisition, for just $325 million, a company it had paid $800 million for in 2021. The stock that once traded at $85 per share had collapsed below $3. A company built to scale online education across America's universities had become a cautionary tale about building a business on a single customer segment with an unlimited appetite for spending. Today we're going to find out exactly why, and what every founder and investor should take from this. In 2008, Paucek and Vikram looked at higher education and saw an obvious problem: colleges were expensive, inflexible, and slow. They founded 2U with a straightforward thesis: partner with non-profit universities to build their online degree programs, and those universities would pay 2U a percentage of tuition revenue. It seemed elegant. Universities got online programs without building technical infrastructure. 2U got recurring revenue from institutions with budgets that never seemed to shrink. Paucek had worked in education. Ru had startup experience. They weren't naive. They understood that universities moved slowly. But they believed that moving slowly was different from being bad at business, and that a technology company with the right operational discipline could unlock billions in trapped revenue. The stakes were clear. Online education was fragmenting. Some universities built in-house. Some partnered with for-profit providers. Some did nothing. 2U's bet was that non-profit universities, the institutions with real prestige, real alumni networks, real hiring power, would choose to work with a specialist who could handle the complexity while they focused on academic quality. The rise of 2U happened in 3 waves. Wave 1 was proof of concept. Georgetown University launched an online MBA through 2U in 2012. Not a certificate program. Not a side offering. A full degree. More universities followed. University of Florida. Duke. Northwestern. By 2015, 2U had enrolled over 50,000 students and was generating 9 figures in revenue. The model worked. What made it work was brutally simple: universities trusted 2U because 2U invested capital upfront. If a program failed, 2U absorbed the loss. This wasn't theoretical. 2U would spend millions to build curriculum, hire course designers, set up student services, before collecting a single dollar. This created a moat. Universities didn't have to risk their reputation on an unproven online program. 2U did. Wave 2 was going public. 2U IPO'd in March 2014 at $13 per share. By 2017, the stock was trading above $100. Investors loved the recurring revenue model, the growth trajectory, the fact that 2U was essentially printing money from the world's most conservative institutions. Universities couldn't negotiate because they had no alternative. No other company offered what 2U offered: white glove service, outcomes guarantees, and the ability to launch a program in 6 months instead of 3 years. But here's where it gets interesting. 2U's growth was real, but it was capital intensive in a way investors often failed to grasp. To land a Duke or an MIT, 2U didn't just build a website. It hired entire teams: curriculum developers, enrollment specialists, student success coaches. Some of those costs were baked into the revenue share. Some weren't. The margins looked better on the spreadsheet than they worked in practice. Wave 3 was expansion through acquisition. In 2019, 2U bought Coursera's parent company edX for $800 million in stock. edX had 50 million registered users, a brand, and a fundamentally different model. Where 2U worked with individual universities on degree programs, edX offered free or low-cost courses at scale. The acquisition made sense in theory. 2U could use edX's reach to funnel the users into degree programs. But what nobody fully acknowledged was that these were 2 different customer relationships, 2 different unit economics, and 2 different markets. At the moment of the edX acquisition, 2U believed it had solved education. It had a moat. It had growth. It had a scalable model. The valuation implied that margins would improve as scale increased. Nothing seemed capable of stopping this. But there was something nobody saw coming. The turning point arrived in 2022, but the decision that created it happened in 2021 and early 2022. During the pandemic, something shifted in higher education. Universities that had been skeptical about online programs suddenly needed them. Enrollment in traditional programs dropped. Remote work showed companies they didn't need credentials as proof of qualification. And new competitors emerged. Google, Amazon, and Meta launched free or low-cost credentials. Boot camps multiplied. Employers started hiring based on portfolios, not degrees. 2U's response was to double down on the capital-intensive model. The company launched new partnerships. It invested heavily in edX. It promised Wall Street that growth would continue. But universities, watching the same trends, started to get nervous. They began asking a harder question: why do we need to pay 2U 60, 70, sometimes 80% of our tuition revenue when we could build programs ourselves? During the pandemic, many universities learned that their own IT teams could actually handle online programs. The moat wasn't a moat anymore. It was friction. By late 2022, a critical mass of universities had either renegotiated terms with 2U, paying lower percentages, or moved programs in-house. Enrollment growth slowed. The cost structure 2U had built for 40% year-over-year growth no longer made sense. In November 2022, 2U disclosed that several major programs would underperform. The stock tanked 80% in a single month. Wall Street realized what 2U's management had delayed acknowledging. The company had signed long-term partnership agreements when its negotiating power was highest, and now those agreements were worth far less than the cost of servicing them. What followed was a managed collapse. In early 2023, 2U laid off 20% of its workforce. By mid-2023, another 10%. The company that had spent $800 million on edX spent the next 18 months trying to offload it. Potential buyers saw a company with 50 million users but no clear path to profitability. By March 2024, 2U sold edX for $325 million, a loss of $475 million on paper and an infinite loss in confidence. Chip Paucek, who had built the company and remained as CEO, was replaced. The stock that had once signaled the future of education now traded at $2.87 per share. 2U still operates. It still serves universities. But it operates with 40% fewer employees, without edX, and under the constant assumption that its partnerships could be terminated with short notice. What happened? The company didn't fail because it was badly run. It failed because it built a business on a single assumption that changed, that non-profit universities would continue to need an intermediary to launch online programs. Once universities developed the capability themselves, or decided the cost wasn't worth it, 2U's entire model compressed. Two lessons that apply far beyond 2U. First, a moat that depends on the customer's incompetence is not a moat. 2U's competitive advantage wasn't that it was the best at building online programs. It was that universities were bad at it. The moment universities got better, or decided they could afford to get better, the advantage disappeared. This matters for any business that sells to enterprises. If your value were easier than building it yourself, you have an expiration date. The day your customer develops the skill or the budget to compete, you're exposed. Second, capital-intensive growth that assumes unit economics will improve with scale is a bet, not a plan. 2U spent money to land customers with the faith that scale would compress costs. But education doesn't scale like software. Every partnership requires real people. Every student requires real support. When growth slows, you don't have the leverage to renegotiate. You have the burden of paying salaries that were justified by growth that no longer exists. The lesson is uncomfortable. If you're only profitable if you're growing, you're not profitable. You're speculating. 2. You spent a decade looking like it had solved education. It had actually solved the problem of acquiring capital on the promise of growth. When that capital ran out, the actual business was smaller than it had ever looked. Subscribe to Tech Postmortem. We break down one tech story like this every week.